Hey, everybody. Welcome to the very first episode of Payments Corner. I have my old boss, Jacqueline Chilton, here. How are you doing?
Doing great. How are you doing, Jordan?
I'm doing pretty good. So, we have announced that we are going to be doing this show, and we're going to be talking focused on payments. I think that there's a lot of people in our industry that do payments, that encounter payments, and are adjacent to payments, but might not have the level of understanding that they would hope to have. So hopefully, as payments things happen, as news breaks, you and I can help them out with that. So how does that sound?
Sounds perfect.
So you and I were discussing where we should start with this first episode, and I think that you decided that we should start at the basics. So yeah, that's where we're starting today.
Fair. Yeah, I always think that starting with payments is to help people understand why it's complicated, where what makes it difficult, and why it isn't as easy as just getting a rate, knowing what your rate is in payments. I think the as people that monitor fraud and payments, we're always talking about whether the customer is getting blocked or not, right? When
Yep.
you have fraud, you're trying all the time to accept more customers. When you have payments, it's the same thing. It's how do you help customers get through that payment thing without ever thinking about it? I think if you look at Uber, they got that down, right? You stopped having to think about watch the till with the taxi driver, count up and up and up during your ride, and think about how much you were going to tip and hand over cash. And they got rid of all that with an app experience that you don't even think about payment. You can even go and change the card after the fact now, right? Um, so payments is just a really interesting space. It has a lot of room for improvement when you actually get into it, and then has a lot of complexity around the fees that people don't really focus on, but should once they move to an interchange plus agreement. So
Yeah. So let's start breaking that down in just a minute. But I think for a lot of people listening, probably their first experience is going to be taking payments from one of the quick and easy companies like a Stripe, which is totally great. Like that. I said even on my last show, even on some of the other shows, that if Stripe had existed when I had my skateboard company, I probably would be sitting in this chair today because it would have been successful. They made it really, really, really easy. And I think that a lot of people, when they start their stores or they start their e-commerce or their apps or whatever it may be, it's really easy to plug in Stripe, pay the 3.5%, whatever it may be. I believe they call that blended, right? Am I
yep,
right on that?
yeah.
And then your 30-cent fee, and there you go. As far as you know, you're taking payments, and all is good in the world. Now, I think for businesses like mine, my day job, that there was a level, and I think most companies, there's a level where that's fine. But then you hit a certain mark where you start to look at it through a different lens. And when you look at that, when you start to be like, okay, could I save money here? It's beyond just, can I get a discount on my rate? Because there's so many parts. So could you help us with some of those parts, please?
Fair, yeah. So I think the graduation point from a Stripe and an Adyen, a PayPal fixed rate, right? Those companies still offer sort of more advanced services, but usually you're moving up into talking about what is your acquirer taking and what are they giving? What is the interchange they're passing through, and what's their markup? So the three big components in a rate are what the acquirer or payment processor that you're talking to is taking. They're usually taking a very small percent or a very small fee over the top. Then there's the what is interchange. So what's actually going to the card issuer's bank? That piece is relatively fixed.
Yeah,
In the
relatively.
industry, it is a matter of choice of the consumer, which card shows up at what time. So if they want to use a commercial card or they want to use a consumer card, the rates are different based on a rate schedule published by Visa and MasterCard. And then the third component is Visa and MasterCard fees themselves. So the brands or American Express or Discover, they have their own set of fees that they charge for doing their jobs over the top, usually related to the brand. And those are usually charged to your acquirer. So what they're called can be very different to a merchant, but the merchant's essentially paying three components: a processing fee, a brand fee, and an interchange fee.
Yeah. And like I think that it is important to really drive home that for the most part, with very few exceptions, interchange is there's a period there. You're paying it, and that's just what it is. And that's where you see certain countries and certain regions are doing certain legislation around those things. That's a topic for a different day. We're not going to
Mhm.
go into that. But those things are have certain amounts that they can be capped at, basically, essentially in certain regions. Now, the other fees, though, is where there's some movement there in some places. So that's where usually you can find some sort of ground working with your acquiring partners, with your processing partners on what those fees could be. Now, of course, if someone's doing, I think that it's important for people to understand that I think regular basic consumers don't always think about it because there is infrastructure that goes into taking payments, and that
Yeah.
infrastructure costs money to run.
Yeah.
It costs money to set up. Like, they always do like the drugs. Takes money in R&D to build it, then you could X amount of fees to recoup it. But there is money to keep the infrastructure, to keep the tokenization, to keep things safe and secure, because that's what we all want when we're processing payments. So you're never going to get to process payments for free, probably. But so there has to be money that has to be made. But what you can do and how much you pay for the size of your business can be worked on. So, do you have any hints, tricks, ideas, or even, for me, I guess, as you kind of started to, my mind immediately went when you started saying when you start to get to that level. Do you have an idea, or how do you know when your business is at that level that you should start exploring what you could do around these sorts of fees?
I think it's when you go to a place where you're prepared to do a request for proposal. If you don't have the bandwidth or the resourcing to monitor and manage a partnership, then you want to be a receiver on all this stuff and you want someone else to tell you what the rate is and to just work on other things. But once you have the ability to have staff and access, to that ability to staff against this, you should be able to sort of forecast that you can save enough money to cover an FTE in the payment space. That's sort of the way I would look at it, right? And what do they have to do? Well, they take two acquirers or four
Yeah.
acquirers or five acquirers, and they bid them against each other, right? And sometimes that's sometimes what you're buying is straight up tech services, and they need to have a certain technology in order to work with your tech stack. So you need to know that going in. And sometimes that's a very specific type of API or page, payments page, right? That you want to call from a certain type of tokenization that you need. And so you do need to know your tech requirements to know who your acquiring possibilities are. Um, but once you're sort of past that, doing a request for proposal or a request for quote, however you want to, however long in length that you want it to be, is really pretty quick to get the acquirers to start quoting Interchange Plus Plus or straight up just better rates across the board.
Can you tell us what you mean when you say interchange plus plus?
Sure. Yeah. So Interchange Plus Plus means that you're getting the pass through interchange that's the rate table from Visa and MasterCard, plus any assigned fees from Visa or MasterCard, or I'm summing up like the markups for American Express and Discover as well. And then the plus is a fee or a charge from your acquirer. So instead of a blended rate that comes as the same percentage on everything, you see the actual rate of your cards.
Hmm.
And the way to believe that you would be able to make money doing this is to look at the interchange tables that are available to you and to figure out then what um, what a benefit would be on changing the markup. So
Yeah,
interchange is going to be 80%, say, could be 70% of your total fees. Then you figure out if I got a discount on the remainder, which is my acquiring fees, what's that worth?
yeah. So essentially, if I was me and I was trying to set this up, I'd want to look at, well, I'd probably have somebody do it for me, like on a or manage an RFP at my level. But if I was first starting to do this, I would say personally, like, here's all my data. These are the types of cards that I'm getting, so I know how many Visa, how many MasterCard, and then even inside of that, go a layer deeper. How many of like the premium Chase cards am I getting? How many of the commercial cards am I getting? Am I like, if you're like company like Cintas or something, you're probably getting a tremendous amount of corporate cards, trying to buy fleet cards, trying to buy, you know, products for their warehouses that have a different rate than consumer cards. But if I'm selling, Saint Laurent bags, I'm probably having a higher percentage of higher end credit cards. So I would want to know the types of markups on those types of cards, because they're going to have the interchange for those cards, right, is different than a traditional debit, traditional credit card, right?
Yeah,
So you need to
absolutely. And
know
if
all
you
that.
see you've suddenly got a reason to see more debit than credit, you know that your blended rate may not be working for you the same way it used to be, just because you were priced at a credit rate and now you're at a debit rate. And so either you go back to your acquirer and you start talking about these things. I do think where this all gets very interesting is we talk about the fee side, but it's the acceptance side that can run your business.
Okay.
Well, you have to figure out on the acceptance side. Um, well, I think there are two things: the acceptance side, and there's the risk and underwriting. So you need to know, is your business model something that your acquirer wants? I think there are higher risk businesses and lower risk businesses, and some acquirers do better with high risk and some don't. So you need to think about that. The acquirer is, or the payments processor is underwriting your business risk to the payment system. And what that means is if you go bankrupt and you've taken a bunch of payments from customers, your processor has to make good on those payments for you. And I don't think everyone appreciates that anymore. Like we see all these
Yeah.
you can pick a Stripe, pick an Addy, and pick a so and so. Doesn't matter. Like, what's the difference, right? Well, they're taking the risk. So, like, checkout.com comes along. They're taking your risk to the network. If you go bankrupt tomorrow after signing up with Checkout, getting a whole bunch of payments, and you can't pay, they do. And
So
so you want a company that wants you, right? And so you need to find which niche you're in, which segment you're in, and which acquirers actually target your segment in order to accept your risk.
and that's where you see some companies require certain businesses to have like deposited money in these accounts. Like they have to hold a certain X amount of dollars, 20,000, 200,000, depending on the size of business, to kind of mitigate that risk.
Yeah, I mean, I just think we got so it gets so easy and it becomes like a who can I integrate to quickly in some startup
Mhm.
situations that I think we forget the financial piece of underwriting a whole business underneath. So the traditional acquirers don't let you forget. You have a little bit more paperwork to do to sign up with a traditional acquirer. The traditional ones being like well, and then some of them have modernized lately, right?
Yeah.
But they started out asking for a lot, like the Bank of America's underwriting side and the Chase and all that good stuff. Like the ones that come from the banking side, they are coming at you with some paperwork to get you started, usually, um, uh, for good reason. In the end, if you want to increase your volume, you end up with that paperwork with whomever you're working with, right? Just to make sure that they can underwrite your risk. But some people looked at it as transactional risk, and some people looked at it as corporate risk. And the traditional bankers came at it as corporate risk, looking for your P&L, your tax returns, and the PayPal's of this world let very small companies start up with transactional risk. And so that
Mm.
makes it quicker. But then you want to increase those transactions and increase those transactions. They're going to start noticing your risk, right? And you have to make sure that there's no holds on your account or whatever consequence there might be of reaching your risk limits. So, anyway, two different approaches, both legit. And at some point when you're a big enough business, you need to make sure your business risk is understood and that the partner you have on the other end is working with you on that side of things, isn't going to hold funds all of a sudden because they think you're risky.
Yeah.
But the other one we were talking about was acceptance. So
Yes.
to move over onto the acceptance side of things, there's big differences between acquirers on acceptance and what the features that they focus on to help you with acceptance. And this is where fraud and payments go hand in hand. One of the big things the payments networks are accepting is risk. They are like, do we think this credit card is actually being used by the customer or not? And if we don't, or if we think we have a reason to believe the last transaction was fraudulent, they're going to put a hold on the next transaction on your credit card, right? And everyone's had a transaction go through their credit card these days that's been fraud. So
Almost
it's a good
everybody.
thing
Yep.
that there are these neural nets out there that the banks are using to block card fraud. But if you put a fraud tool in front of your payment authorizations, you can see a huge lift in that acceptance rate because the issuing banks won't be as worried about your business. And so the cards will accept more of the charges going to your business. So anyway, your acquirer has a role to play in helping you with that and making sure that your traffic is as clean as it can be through the system to get your acceptance rates as high as possible.